The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Hello and welcome to Squawk Box. We are live from our London studios, the European Central Bank in Frankfurt and the trading floor of Barclays headquarters. Here are your headlines today. The ECB is poised to cut borrowing costs for the first time in nearly 5 years, marking the end of its tightening cycle. Former board member Peter Praet tells CNBC the market is still adjusting to the ECB's looser policy.
The ECB was criticized as being too hawkish, actually, in terms of rates. Now you see the opposite situation, where the market's actually a little bit more hawkish than what we expect from the ECB.
Nvidia's market cap crosses the $3 trillion mark, overtaking Apple to become the world's second most valuable public company behind Microsoft.
Meanwhile, the S&P 500 and Nasdaq hitting record highs. This as US services activity picks up, but private job creation slows in May. And yes, we write the same headline again, further raising hopes of a Fed cut by September. And the world commemorates D-Day, 80 years on, with global leaders gathering on the beaches of Normandy as war once again casts a shadow over the continent. Normally, we stand here when there is big news ahead.
There is big news ahead.
No, it's done.
Well,
it's done. It's been done for about 3 or 4 weeks.
But this is the debate. Is it big news in that we're on the cusp of a cutting cycle for the ECB, or we're on the cusp of one rate cut today?
Now that is the news.
Exactly.
Yes, absolutely.
As we're watching the ECB this morning, we count down to what is expected to be the central bank's first rate cut since 2019, with markets pricing in around 97% chance of a 25 basis point move lower today. And Steve's point is this all baked in. Now, with a certain cut likely for the markets, attention is already turning to what comes next. Traders are split on whether the ECB will deliver 2 or 3 rate cuts by the end of the year, pricing just under 65 basis points of easing, according to LSEG data.
Yeah, there's some great stuff out there as well, and including Carl Weinberg sent you and I an email saying, maybe 50 today. I mean, it wouldn't be unprecedented. It's been done before.
That seems unusual. If you wanted to move 50, you would just move next month. There's no need to send a message today on a 50 basis point cut.
If you think we're tame, if you think we're too low handle on inflation and that's where it's going to stay, go for it.
Some don't even think we're there for a follow-up rate cut next month, let alone front-loading it to today.
I'm just putting it out there as well. It wouldn't be the most unprecedented thing ever. In fact, they went for 50 3 times. They went in 2001 and 2003. They went 50 basis points.
But that was as we were talking about recessionary signals coming for the economy. This time round, we've come out of the slump. We've been in recession,
you sure?
And we've come out.
Have you seen the German manufacturing?
Well,
Have you
we're
seen
talking
what's
about
going on elsewhere?
but we're talking about the Eurozone. We're not talking about just one economy. And that's the problem for the ECB today. Dilemma as to very different numbers across the bloc.
Well, the timing of today's expected rate cut is in some ways unusual for the ECB. The central bank launched previous rate cutting cycles, as Karen just absolutely right, spot on said, in response to the financial crisis of 2008 and the Eurozone debt crisis in 2011. Why don't we have a Eurozone debt crisis now? I'm just chucking that out there. There's a question for you. And most recently in response to inflation falling below the 2% target in 2019. But today the ECB sees an improving economic picture. Okay. Optimistic. With inflation at target next year and an improving top growth outlook. I would question a couple of things in there as well. Are we actually, if we're not in recession, are we in a growth pattern as well? And I think that's a big question mark because let's face it, growth has been anemic, insipid at best as well. And two, I just asked that question there. Why aren't we in a debt crisis? Why, when actually nations are topping out on their debts to GDP, high as they've been, in fact, they're higher than they were in the 2008 debt crisis as well. And indeed, we don't have growth. And indeed, the rating agencies are beginning to downgrade some of the biggest nations in Europe as well. Why don't we have a debt problem? And is that, again, part of the problem or the solutions that are coming from the ECB?
Well, don't forget there's another arm here, and that's fiscal policy. So a lot of the big plans have been paid for.
That's what I just said about GDP.
Right, have been paid for at a European level, not necessarily at a country level now. So there's been a big kitty that's been established thanks to
I hate to say it, but our headlines were about the European parliamentary elections. And if you think there's more federalism coming and more joint kitty spending coming, then you haven't seen, or our viewers haven't seen, what the right wing have been saying, because they're not having more of that.
Yeah, so one of the bigger issues, what lies ahead, and that's obviously what we're debating today. And I think one of the concerns is that we have been in a very weak environment. We've climbed out of the hole slightly, but we're not quite there. And there is concern genuinely what lies ahead on the growth position. Don't forget the United States has been very strong, and some of that spillover effect has been helping other parts of the world economy. If the US starts to slow as well, China hasn't exactly been firing on all cylinders, then you have this global effect that also impacts the Eurozone just as it's getting out of a slump. So I think there are still growth concerns ahead, even at the same time when there's sticky inflation. We're not back to target. The question is whether we get back to target anytime soon. So these projections are going to be very, very key today as we look ahead. And let's get out to Annetta, who has been set up to talk about this very event. Annetta, just weigh in on some of the conversation points we've been making here and what you think is all important today.
Well, I guess what the market and we are all focusing on is whether we get some forward guidance from the ECB or whether they are going to insist on being very data dependent at every session we are getting. So I guess, of course, the rate cut today of 25 basis points is more or less a given. And the question is whether they are so optimistic about the path of inflation and also economic growth staying buoyant that they're going to cut again in July. And I guess that's highly questionable, given what we heard from commentary out from various policymakers going into that crucial meeting. And it's an historic meeting because clearly what we probably will get is now the start of a rate cutting cycle. The key question is how independent the ECB actually feels from the Fed policy setting. I guess that's the key issue here, because if the Fed stays put and the ECB would really start to cut forcefully, then we have an immediate effect on the exchange rate, and that could mean that higher prices through import prices will push inflation again a little bit higher. But perhaps to give you more context and also perhaps more insight of the thinking of the ECB, I caught up with Peter Praet, the former chief economist of the ECB, yesterday, and asked him what he thinks of the policy path ahead. Perhaps we take a listen.
The 25 basis points cut, I mean, it's not a big issue. The big issue is, of course, how confident the ECB is on the future path of inflation. And we're going to see the new projections. I think in the new projections, what we will see is that the ECB has more confidence in its base scenario. And I think even that they may say that the risk to growth are more balanced now. I think that's an important signal, and I'm looking forward.
The key question is what happens after June, whether this is the first of rate cuts. So what are you expecting? Is that the start of a rate cutting cycle, or is that just a rate cut because they have promised?
I think the ECB will remain very careful. I think that has been very well communicated in March at the ECB Watchers Conference, where Christine Lagarde in her speech, very clearly said, the future path of monetary policy and the criteria to change or not interest rates. So I think that has been clearly communicated, and the ECB is right on that sort of scenario. You remember that markets were too aggressive in terms of expectations about rate cuts, and the Governing Council in general was uncomfortable with very aggressive rate cut expectations from markets. And the ECB was criticized as being too hawkish, actually, in terms of rates. Now you see the opposite situation, where the market's actually a little bit more hawkish than what we expect from the ECB. So I think the ECB is quite comfortable in terms of, getting more confidence about its own projections, about its own, policy orientation. But below the surface, I think that deep concerns among the Governing Council members about the future. path of rate. I'm not talking about the very short term, the next few months. I'm talking about what will happen, for example, after December. As you know, rates probably will be cut, in September and probably in December. But I remind you that in December, we will have the results of the US elections. We will know a little bit more about the European Parliament and what direction, European policies will go. We will know more about fiscal policy, actually, in the euro area. And so there are deep concerns, I think, in the Governing Council about the future policies, not monetary policy, actually. I think they have a clear view of what should be done, but about the other policies.
I think it's fascinating to hear what kind of parameters the ECB is looking at, because it's a wide bunch of parameters. It's not only energy, it's of course also the outcomes of these various elections, because they all might have an effect on how they can do their policy setting here in the euro area, be it because there might be less fiscal spending, but also there might be more trade disruption that could actually again push prices higher. And at the end of the day, it's also about whether there's more willingness after the European election to actually integrate Europe further and to have, for example, an intact banking union and a capital market, a deeper capital market, which could revive economic activity as well. So to bring you back to your point of anemic growth in the euro area, Steve, I think we have seen anemic growth for more than a decade here in the euro area, and that is because of various factors. The economic forces here are not as dynamic as in the United States, because clearly we don't really have one big domestic market because of all these regulatory differences. And a banking union, a deeper capital market, that's what I hear from everywhere, is a crucial step ahead to have more economic dynamism and also more of a economic common market. But it is highly questionable whether after this European election, where we most likely will see a shift to the right, there is enough political will, enough political capital to actually push that forward. So I think anemic growth is here to stay, I have to say.
I'm really surprised you say that, because I thought that CMU was something we talked about a decade ago, and a single capital market. Here we go. The EEC set a deadline of the 31st of December. 31st of December, 1992 for the completion of a single market. Can't believe we haven't got a single market, and I can't believe we haven't got CMU. What on earth's going wrong? Sylvia's next, of course. Annetta, thank you very much indeed for that. We used to have a Sylvia, did the ECB. She was brilliant as well, almost as brilliant as Annetta. Moving on, uncertainty on what will come next from the ECB hasn't been helped by a disagreement among central banks governing members in their commentary since the last meeting. Really, I thought they've all been pretty uniform. Anyway, let's look at this. Brilliant chart. Thanks, team. Klaus Knott. He's gone past. Adam, go back. Go on. We don't often do that, do we? Go on. Should we start again? There's been disagreement. Do you know what? We practice this for hours. OK, so Klaus Knott saying the optimal policy would have been 3 to 4 cuts this year. Robert Holtzman, we love talking to him. He's in the middle, Adam, if you want to move on. Robert Holtzman and Isabel Schnabel. She's a bit more to the right. I'll take my time. Robert Holtzman and Isabel Schnabel. We'll get to Isabel in a second if I just carry on talking. They're striking a more cautious tone. Well done, Adam. We got there. Third time lucky. Anyway, whatever the ECB does today is sure to have an outsized impact on the market. Sylvia's on a trade. Do you know, when I was on a trading floor back in the day, it was heaving with activity at this kind of time of day. Heaving with activity. Are they in? Is any of them there? Barclays trading floor? Where are all the Barclays traders? What are they doing? Are they getting their frappuccinos, or are they down the gym? Where are they all?
They're just about to start arriving here to start their working day, Steve. And I can imagine that you're having a couple of flashbacks to back in the day when you were in one of these as well. But no doubt that this is also an interesting day when you think about the markets here. This, I should say, actually, this floor is focused just on equities trading. And we're here because it's actually a good example, really, of where a lot of the action will be taking place today in the context of the European Central Bank meeting. meeting. Now, with that in mind, I have to say that the house view of Barclays is actually that we are going to see a rate cut today of 25 basis points from the ECB, and that this is going to start a rate cutting cycle of 150 basis points until June 2025. Now, so this means that according to Barclays, we're likely to see 75 basis points of cuts between now and the end of the year. Now, if you compare this forecast with other banks out there, for instance, Citi or Standard Chartered, they are a little bit more aggressive in terms of rate cuts between now and the end of the year. But let's see whether or not we're actually going to get a little bit more clarity from the ECB, from President Lagarde later on during the press conference. Barclays, however, believes that the ECB will keep the rates guidance unchanged exactly to give the central bank that flexibility going into every single meeting. And it's actually interesting here when you think about their forecasts for upcoming rate cuts. They are very much putting them at the end of the quarter. So every time we're getting the ECB putting forward new macroeconomic projections, Barclays believes that we're going to get rate cuts at the same time. And of course, this is also a day when we're going to get new macroeconomic forecasts from the ECB. And with that in mind, in terms of inflation expectations, Barclays believes that the headline and core forecasts will be increased to 2.4 in terms of headline inflation for this year and core to 2.7%. Core is a very important one because markets will be looking at this number and trying to understand what is the psychology in the ECB in terms of core inflation going forward. Because if this actually increases materially, then perhaps there's room here for the ECB to actually be hawkish going forward, more hawkish going forward. Let's see. All eyes will be on that rate decision, on that macroeconomic forecast, and then, of course, on the commentary from Christine Lagarde later on today.
Sylvia, thank you very much for bringing us the coverage. And you can find out plenty more on CNBC.com, our website, as we gear up for the big event today. Don't miss our special programming this afternoon and what will be perhaps the most consequential ECB meeting in years. That is right here at 1400 CET.
Anyway, so who have we had who have cut so far? I mean, obviously a lot of places, but the Swiss have gone. The Swedes have gone, and now the first G7.
Canadians, yes.
The Canadians have gone, yeah. The Bank of Canada cut its key policy rate by 25 basis points to 4.75% on Wednesday, as expected, and said more easing is likely if inflation continues to ease. This after inflation slowed to a three-year low of 2.7% on the year in April. Goodness me, it's a busy show. Coming up on the busy show, Nvidia overtakes Apple to become the world's second largest company by market cap. Some of you actually care about that. We'll have the details coming up next. Plus, the President, Joe Biden of the United States, will today mark 80 years. Wow, since the D-Day landings alongside other world leaders. We'll discuss more later this hour. And we'll bring you more of our coverage ahead of the ECB's decision today. We'll be speaking to the former ECB Vice President Vitor Constancio. Tune into that interview at 10:15 Central European Time.
Ambition to me is about doing better.
I think ambition creates a pathway.
Best advice I can give to someone starting off a career is don't have a career, have lots of careers, try loads of different things.
Talk to people and put your ambition out there.
I don't feel that I've hit peak ambition because it's a learning journey.
CNBC is where ambition meets opportunity. What does living ambitiously mean to you? Hear it from our CNBC anchors, reporters, and global business leaders on CNBC.com.
US markets bouncing again yesterday. Fresh records on some of the major boards, from the S&P 500 to the Nasdaq, both intraday records and records on the close. Again, technology names really leading this charge. Semiconductor names, Nvidia getting to the $3 trillion market cap and becoming the second largest company stateside, and I should talk beyond the states, in the entire world. In terms of size, what we're seeing now, these gigantic names created on the back of this AI innovation, taking with it the major boards from the Nasdaq to the S&P. In that context, the Dow is somewhat left behind, so highlighting this AI thematic that remains in markets. The Dow up just 0.25% by comparison. For the trading week, we've also put on gains. We've stretched higher on the Nasdaq to the tune of almost 2%, about 1.5% stronger for the trading week on the S&P 500, thanks to gains yesterday, and up by about a third for the trading week on the Dow. So left behind in the session yesterday and left behind for the trading week. Let's take a look at those big tech names, and you can see the extent of the gains in that session. Meta, AMD all playing in the rally, very strong ranges there. Nvidia, as you can see, the outsized performance, and we'll get into that in some more detail. But elsewhere across the boards, we had Microsoft up nearly 2%, decent returns on Alphabet and Amazon after the trade, more than 1% in the green, and a little bit on Apple and Tesla. Tesla a little bit left behind, as you can see, in that tech rally. To treasuries, and what we're witnessing again, still a debate on where we sit with monetary policy, whether we are watching those rate cuts materialize this year, and just how many are still in sight. We're 4.3 at the long end, 4.74, so just under 4.75% at the short end trade. To the dollar, in that context, as we take a look at yields, we are again seeing a little bit of strength come through for the European currencies. Sterling, we're 127.91, so just perched off 128. Euro dollar, the huge focus today as we waited out for some potential guidance from the ECB, updated forecasts, and of course, that first rate cut is expected to be delivered today. We are trading up a little bit, just over 0.1%. Elsewhere, dollar is on the back foot too, Steve.
You know, we've got, and I know why our producers do it. They write every day. They write, and heightening the chances of a September rate cut every time we have a kind of like mildly weaker jobs figure. Well, what does this ISM figure do from yesterday? Shall I just remind people what? Should I do the read or should I? I'll do the read. Here you go. Look at this. Activity in the US service sector picked up in May, with the ISM services PMI recovering, wait for it, to a 9-month high. Does that increase the chance of a September rate cut? Just chucking it out there, guys. Recovering to a 9-month high of 53.8 after a contraction in April. That is well ahead of expectations. How about this? Rising new orders contributed to a higher number. Export strength. Shall I go into the detail on the export strength? I think Adam really wants me to. Export orders jumped from 47.9 the previous month, to 61.8. That's an 8-month high. It's got a 6 handle.
The slight problem with this data point too is that it's forward-looking. It's not backward-looking, so we can't say there's some catch-up happening.
Boom. But in the meantime, the US private job creation slowed a little bit more than expected in May, with the companies adding 152,000 jobs. Still adding jobs, though, down almost a fifth on the month and well shy of expectations. According to payroll processor ADP, nearly all the hiring came from the services sector, with goods producers contributing just a net 3,000 to the total. ADP chief economist Neela Richardson told this channel the numbers reflect pockets of weakness.
It's generally a good number, plus 150,000 or so jobs in most economies is a great number, but there is a little weakness under that hood. There's weakness coming from traditionally white-collar jobs like professional business services. We saw loss. Information services, we saw loss. We also saw losses and weakness tied to both producers when it comes to manufacturing and consumers when it comes to leisure and hospitality.
The US Federal Reserve will cut its benchmark interest rate twice this year. That's a kind of almost a statement of faith rather than reality, potentially, isn't it? With the first cut coming in September. Well, anyway, that's according to the majority of economists. What do they know? Economists in the latest Reuters poll. It also found a significant risk of only one cut or none. Here's the thing. You're going to read a load of stuff on Nvidia. What's new?
The market cap.
Yeah, that's true. Yeah.
The positioning in terms of ranking stateside.
Yeah.
The way the CEO was mobbed in Taiwan this week.
Wow. What, like a rock star?
Exactly.
Wow.
Yeah. Nvidia has overtaken Apple to become the world's second largest company by market capitalization after breaking the $3 trillion barrier in Wednesday's trade. This ahead of a 10-to-1 stock split set to become effective from tomorrow after the company's share price surged from around $38 5 years ago to over $1,200 today. So returns, I think we all agree, was stunning last year. Returns this year have been incredible as well, 147% up so far this year. A lot of retail money apparently flooding it as well.
And if you think about
like
a rock star.
Exactly.
I thought that was John Bon Jovi.
Well, the leather jacket, was that what you, the association?
Well, that and John Bon Jovi's got a shock of grey hair these days, like a lot of us.
Right. So the retail investor loves an easy trade. FANG Plus stocks were an easy trade in recent times. For some, Bitcoin. For others, some of the GameStop meme type of names. Retail investors like this one because not only is it high profile, it's had decent earnings to back it up, and the returns have been very quick to come through. And this is exactly the type of stock a retail investor likes. So that has been one of the reasons why we're seeing an escalation. And there is a view it could also move past Microsoft in coming weeks and months on the back of some of this euphoria.
Let me get Rumsfeldian about this. The the Donald Rumsfeld, the Rumsfeld quote, about known unknowns. So there are four types of companies out there. There are rubbish companies with rubbish valuations. There are rubbish companies with good valuations. There are good companies with rubbish valuations, and there are good companies with good valuations. We get it. This is a good company with a stratospheric valuation. So it ticks the first box. It is a great company. It ticks a sub box, which is good company with amazing growth potential. The only question for all our viewers, I don't think any of our viewers think this is a rubbish company. I think they all think it's a good company, is the valuation too tasty? And the FT have done a little bit of work on this, just very briefly. On Wednesday, it was valued at 42 times expected earnings next 12 months. That is up from 23 times at the start of the year and well above Apple's 29. And we can go into all kinds of other metrics as well. But it is a fruitily valued company, to put it mildly.
Well, here's the other metric. It was trading on 70 times expected earnings about a year ago. So what would you rather own, Nvidia back then when it was trading on 70 times, or now when it's trading on 42 times? Well, when it was trading on 70 times, we had an enormous run up in the stock price. So it might have looked fruity then, but hey, you've been well and truly rewarded for taking the plunge. Now, as we talk about competitors coming at some stage, how does that 42 times look like? Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.